Hey, before we can go on, we have to talk about economic indicators, which is a fancy term for a couple of statistics, but they're really important ones that economists use all the time. So you need to really understand a little bit more about them before you hear them over and over again in the rest of this topic. The first one is gross domestic product. The second is unemployment, the unemployment rate, and the third one is inflation, which is usually measured by the consumer price index. We're not going to talk much about the index, but we'll talk about what it measures. So GDP stands for gross domestic product, which literally means gross, the total product, amount produced of goods and services, domestic, in your country. It doesn't matter if you own it or a foreigner, like an American or European owns it. If it's produced in your borders, it's GDP, and it's usually measured for a year. In real English, what's it mean? It means it's the size of your economy. There's two ways to measure it. In this course, you're only learning the expenditure approach. One of the next topics is the circular flow of the economy, and it becomes important to understand that every dollar of income to someone is a dollar of expenditure by someone else. If I spend $10 and I give it to a business or a person, it's income to that person, but it was expenditure to me. And you can measure either one, but not both, or you're double counting, right? So the expenditure approach is such that GDP is all the money spent on goods and services by consumers, plus all the money spent by businesses, which is called investment. And it's not like investing in a stock or putting your money in a bank account. It's investment in things like capital equipment, machinery, residential construction, factory construction, that sort of thing. So the stock of capital in an economy. And then the next one is either consumption, consumer spending, so on goods and services, or investment by governments. And it's separated because one, it's really large, and two, this one behaves differently than the other ones, which we'll talk about later. And then the last segment is trade, so the balance of trade, which is exports, because that's what we sell to the world, that adds to our GDP, minus imports, which is what others, which is what we buy from others, which subtracts from our GDP, even though it's expenditure, right here. That's GDP. There's a couple problems, though, that you have to understand. GDP counts expenditure, if it's done that way, which means it's measuring at the same time real growth in the economy because you're producing more stuff, but it's also going to go up because prices go up, and that's not real growth. So the difference between actual growth and GDP going up because of growth and inflation is the difference between nominal GDP and real GDP. Real GDP is actual economic growth, so the inflation is removed. Nominal GDP just counts the sheer quantity of dollars that have been expended. Right? Expenditure, spent, gone. Unemployment, there's three types of unemployment. There's frictional, which is fine, structural, which is good and bad, and cyclical, which you may or may not be able to do something about. Frictional, you will always have it. It's people who say, I've just left university and are looking for a job, or hate their job and just quit and are looking for another job. You're always going to have some frictional unemployment. There's nothing you can do about it. There's nothing you want to do about it. It's normal. Structural unemployment is good in the long run because it means people who have skills, say like repairing clocks, have lost their job because no one buys clocks anymore because they're all going digital, right? Or, you know, a VCR repair person who doesn't have a job anymore because their skills aren't needed, needs to get retrained to do something else. Those jobs, when they're lost, they don't come back. But that, in the long run, isn't necessarily a bad thing because it means your economy is developing, probably, right? The last one, cyclical, comes from the ebb and flow of the economy, right? So the growth, the recession, that is cyclical unemployment. And combined at the lowest possible level of unemployment, you probably could expect 3 to 5%, depends on the country, right? You will never get below that, or you'll get serious problems with your economy in terms of inflation. Full employment, or sort of economic full employment in your economy, is going to be between 3 and 5% unemployment. That's when everybody who can work is working. The biggest problem with this statistic, you got to remember, is that unemployment in most countries is measured by a survey. And when the survey is done, you are asked the question, if you have looked for work, if you're unemployed, if you don't have a job, have you looked for work in the last X number of months? And if you say no, you are not counted as unemployed, even if the reason you haven't is because you've given up. And you would still like a job, but you gave up. Technically, you're really kind of unemployed, right? can't find a job, but you don't count in the statistic, and that's really important to remember. The third item is CPI. What that is basically Statistics Canada or whatever government agency you're talking about takes a basket of goods that a family of 4 usually buys in a year, figures out how much all that is, and then compares it either every month or every year to see how much it has changed. The percentage difference is your rate of inflation. And if you don't know what inflation is yet, inflation is the gradual increase of prices over time. It can be faster, it can be slower, but at the end of the day, it is considered to be one of the most evil things to basically all the economy. For a variety of reasons. One, anybody that lives on a pension gets screwed over because if their income's not going up, then their wealth is going down because they can buy less and less and less with their fixed income because of inflation. Second, anybody that has a pool of savings. So anybody that's a lender of money, anybody that has savings put away either under their mattress or in a bank account that doesn't pay much interest, they get poorer too with inflation. If you make 1% interest on your money, but inflation is 2%, you're actually, even though your bank is paying you 1% interest, you're actually getting poorer. Because your $100 turns into $101 in a year's time. But you need $102, right? With 2% inflation, you'll need $102 to buy what you could have a year earlier with just $100. So inflation is deemed to be not cool. And some of the ways that governments tried to solve, or at least temper, you can't have zero inflation either because that's bad, but we can't get into that, we don't have time. They try to moderate the rate of inflation through a central banking system that controls the money supply, but we'll talk about that later. That's all you need to know about these 3 stats for now.